What is sector rotation in the stock market? Sector rotation is an active investing strategy where investors try to move their money to the industry that they think will perform the best in the next business cycle. It's typically based on these 11 sectors, and each sector is expected to fluctuate based on the economic activity and each business cycle. Although there are different interpretations on which sectors tend to do better at which time, this table shows a general consensus. In the early stage, the economy is recovering from a recession, there's accelerated growth and favorable credit conditions. This tends to favor cyclical sectors like industrials, consumer discretionary, and real estate. Then you have the mid-cycle stage, which has moderate and sustained growth, which tends to favor information technology and communication services. Third, you have the late cycle stage where growth slows down, inflation rises, and restrictive monetary policy leads to inventory buildup. Defensive and inflation-resistant sectors tend to do best, like energy and utilities. And finally, there's the recession phase with economic contraction, declining profits, scarce credit, and falling inventories. That's where defensive sectors tend to do best, like consumer staples, healthcare, and utilities. Although these are popular ETFs that track sector rotation, they all underperform the S&P 500 to date.